Hi, this is Mr. Gideon. So now let's talk more about the money market and the loanable funds market. Both of these are markets for money, or for loans more specifically. But the money market is a place where you would go to find a loan that's going to mature in less than 1 year. The loanable funds market is a place where you're going to go to find a loan that's going to mature in a year or more. The reason we differentiate between these two markets, of course, is because of the role of inflation and deflation. Once we get to the 1 year mark and we start to count in terms of years, we can also start to factor in or factor out the role that rising or decreasing prices are going to have as far as how we evaluate real income, real interest rates, all those things that are attached to the term real. So maybe you're thinking about putting your money into the bank or somewhere else due to your awareness of present value and future value, and because of your awareness of inflation. So let's start with the money market. It's considered the short term. And in the short term, when assets mature or come due in less than 1 year, there are many things you could do with your cash. You could keep it as cash or currency, which, as you recall, is considered M1. And M1 is in table 28.2 down below here. See line 4. You could put that cash in the bank as a demand deposit, which is also considered M1, and that's summarized on line 3 in this table. You could also put it in a short-term certificate of deposit, known as a CD. That's not normally how we're going to use that phrase in this class, but that's considered M2, and that's also summarized in the table. It's on line 2. And as you can see, the interest rates and opportunity costs of holding money in these different forms based on the chart that you see here. These are actual rates that prevailed in June of 2007 and June 2008 change over time. You can also see that the rates as they change typically move together, up or down at the same time and by similar amounts. So if you're looking at the line for the 1 month certificates of deposit, these CDs, as they're known, are agreements that you would have with a bank where you put your money in savings, but you agree not to touch it for a certain period of time. They have 6-month CDs, 1 year CDs, 5 year CDs, different maturities, but we're looking at the short term, less than a year right now. And in exchange for you agreeing not to touch that form of savings for you, the bank pays you a higher interest rate than you would normally get on a plain old savings account. But that rate, the interest that you would get paid on a 1 month CD in June of 2007 was greater than it was in June of 2008, so it decreased. But so did the interest rate that you could get paid on interest-bearing demand deposit. So this is because these interest rates are different places that you as a customer could choose amongst where you want to put your money. You're a valuable customer. Now, let's expand our discussion of the money market and think in terms of the demand for money and the supply of money. The demand for money can be summarized in a couple of different ways, most notably and most routinely in this class through a curve. The supply for money will also be summarized in a curve. But when you're thinking about the demand for money, and we're talking about short term in the money market, as the interest rates of other M1 options besides cash increase, your opportunity cost of holding on to the cash increases. And think about this chart that we just went over. You could not hold on to your cash, and you could lock it up in a CD. You can put it in one of these other sources of money. And that's why the money demand curve in the money market is downward sloping from left to right. The interest rate or the opportunity cost becomes greater for you to hold on to that money as other options also increase in terms of the interest rate. What are some factors or events that could shift the demand curve for money in the money market? Well, if the price level increases, then money demand increases by the same percentage, actually. We'll talk more about that later when we discuss some more theory with regards to the monetarists in particular, because that's how much more money it's going to cost to buy the same basket of goods. This basket refers to the calculation of the CPI, of course, the market basket. If the price level decreases, then that would lead to the money demand also decreasing by the same percentage, because that's how much less money it costs to buy the same basket of goods. Another event that could shift the demand for money is a change in real GDP. If real GDP increases, that would lead to the demand for money increasing so that people can buy more. If real GDP decreases, then that would lead to a decrease in the demand for money because there aren't as many goods and services to buy. People won't need as much money to buy the goods and services that are out there for them to buy. Also, changes in technology. If information technology advances, that would lead to a decrease in the demand for money because people can use debit and credit cards more easily compared to holding and using cash. And then finally, a factor that could shift the demand curve is a change in institutions or laws. For example, when Regulation Q was eliminated in 1980, which had been implemented in 1933, banks could now pay interest on checking accounts, whereas before they couldn't. Well, since that's the case, that would lead to, in this example, money demand increasing. Now, what about the supply for money? The central bank in any country, for us it's the Federal Reserve or the Fed, chooses and adjusts the money supply according to its goals using the discount rate. We abbreviate this with DR, open market operations, and the reserve requirement. So the money supply is vertical. It's fixed in the short run. And make sure you understand the difference between the money supply and the monetary base. Money supply consists of all the currency in circulation, like the cash you would hold in your wallet, as well as checkable bank deposits. The monetary base includes the currency and bank reserves, money that's not being used out there. It's being held in a vault, or perhaps with the Federal Reserve itself. We'll come back to that later. So if we're talking about the supply of money, what are some factors or events that would shift the supply curve for money? Just like we have factors or events that would shift the demand curve for money. Well, one is the reserve requirement or the required reserve ratio, the reserve ratio. All these things mean the same thing, but this is the percentage of demand deposits. Right now it's 10% in the United States that banks are required to keep in reserve and not lend out. Banks must average that over a 2-week period or face penalties. That's just the law. The last significant change was in 1992, so this isn't used much to change the money supply, but it is a tool that the Federal Reserve can use, and we'll talk later about why they would change this, why they would use this tool. Understand the definition of the federal funds rate here. The federal funds rate is the interest rate that one bank with excess reserves charges another bank for loans, usually just overnight loans, to meet that reserve requirement. I mean, as you can imagine, especially with large banks, there's so many transactions happening on a daily basis, thousands and thousands of transactions, that it's possible over the course of several days they might not meet the reserve requirement. And of course, they don't want to break the law. They don't want to be caught breaking the law. And if the law says that they have to put 10% of all the deposits that are made in that bank aside and not loan at least 10% of the deposits out, then if they're found short overnight, they can borrow it. They can borrow it from another bank. They can even borrow it from the Fed, from the central bank. But if they borrow it from another bank, then they get charged a rate, of course. There's no such thing as free. That's known as the federal funds rate. If there's a decrease in the reserve requirement, that would increase the money supply. If there's an increase in the reserve requirement, that would decrease the money supply. But as I said a minute ago, this has not changed a whole lot as a habit, particularly in the United States. And so it's not something that you would usually see change or shift the supply of money in that curve in the money market. Another tool is the discount rate. Now, this is a different rate than the federal funds rate. It's the interest rate that the Fed would charge on loans to banks at what they call the discount window. Usually it's 1% above the federal funds rate if a bank is in need of reserves to meet the reserve requirement. Other than in response to a crisis, the Fed doesn't usually use this much either. But it's something that you do need to know. We're going to come back to a chain reaction that starts with this, but just I want to plant a seed now. If there's a decrease in the discount rate, then that would increase the money supply. If there's an increase in the discount rate, that would decrease the money supply. But option 3 is the one we talk most about. Open market operations. This is when the Fed or some other central bank in another country buys or sells U.S. Treasury bills, or in another country, some kind of federal bond from commercial banks that own them. Commercial banks usually make business loans as opposed to home loans, which are mortgages. So usually open market operations happen between the central bank and commercial banks in that country. Treasury bills are also known as T-bills or treasuries, which are federal government bonds which have a maturity of less than 1 year. And remember, bonds are loans. If you own a bond, what you've decided to do, actually, particularly if it's a government bond, is to loan the government some money in exchange for the expectation that they're going to pay it back with interest at some point in the future. In this case, we're talking about short-term bonds. They're going to mature in a year or less. There are other kinds of bonds that mature years and years from the time that they're issued. Now, the Fed prefers this option due to its flexibility. So remember this, there's an open market sale of bonds that leads to banks' reserves being decreased by the central bank, which leads to a decrease in the money supply. If there's an open market purchase of bonds, if the Fed, the central bank, goes into the market, goes to commercial banks, says, I want to buy some of the bonds that you have as a part of your asset base, that leads to the bank's accounts being credited with extra reserves. They get that from the central bank in exchange for this purchase, and that leads to an increase in the money supply. Now, what about the loanable funds market, where we have maturities of a year or more? There are, of course, factors or events that shift the demand for loanable funds. So this is a demand curve of a different nature. One is changes in perceived business opportunities. Let's say companies perceive some new opportunities. For example, during the internet and dot-com boom, a lot of people were sometimes irrational, frankly, and they're going, oh my gosh, I have to start up an internet company, I have to get a dot-com, I have to put as much money in this as possible because it'll make me a millionaire practically overnight. So obviously there was a lot of optimism at that time, and that would require, if you're one of these people, the purchase of factors of production. Maybe you need some equipment, you need workers, what have you. That would lead to the demand for loanable funds shifting right. If companies are pessimistic, for example, after the dot-com bubble burst, that would lead to the demand for loanable funds shifting left. Secondly, if there are changes in the government's borrowing policy, this might strike a chord with one of our previous lessons. For instance, if the government borrows more to finance deficit spending, that would lead to the demand for loanable funds shifting right, which can be the cause of indirect crowding out. And finally, what are some factors or events that could shift the supply of loanable funds, the supply curve? And remember, from all the shifting you've done already, same things apply here. A shift to the right is an increase in demand or supply. A shift to the left, having the entire curve be redrawn to the left, is a decrease in demand or supply. But think of the supply of loanable funds coming from savers, not the central bank. We are the people, when we save our money, that supply loanable funds that banks, of course, as financial intermediaries, loan to the people that need them long term. What are some things that can shift that curve? And this is not a vertical curve like you would find in the money market. This is sloped upward from left to right. One is changes in private savings behavior, of course. I mean, if people save more, then that leads to the supply of loanable funds shifting right. If people save less, supply of loanable funds shifts left. Changes in capital inflows. If financial capital flows into a country, that leads to the supply curve shifting right. If financial capital flows out of a country, then the supply curve will shift to the left. Now, that's a lot of information, And you have to try to visualize how all these factors could change the equilibrium price and quantity in either one of these markets. But we've already drawn it. And if you have a copy of the Master Notes document, go all the way back to page 73. It's actually not page 73. It's page 37. Got the numbers backwards. But here are the two markets once again. Money market on the left-hand side, which is labeled with a nominal interest rate, and it has little I as the abbreviation. The loanable funds market, which has real interest rate marked on this axis, the abbreviation is little r. As we just said a minute ago, the supply of loanable funds curve is different than the supply of money curve. Supply of money is a vertical curve. Supply of loanable funds is a curve that slopes upward from left to right. And as you can visualize any of the factors that would shift any one of these four curves in either market, you can adjust the interest rates and the quantities accordingly. So think of one factor, for instance, that could cause this to happen, that could cause the demand for loanable funds to shift right. An example we just mentioned was at the beginning of the dot-com internet boom, people saying, I want to open my own business, I'm going to get out there and buy equipment to do so, take advantage of this new technology and try to become a millionaire very quickly. They will have to go into the loanable funds market typically and get a long-term loan as opposed to a short-term loan, and that would increase the demand for loanable funds, which of course would lead to a new equilibrium point, and now we would have a higher real interest rate as well as a higher quantity of loanable funds available in the market. Maybe some other factor, like the government engaging in deficit spending. And so typically they would go into the loanable funds market and they would be a part of the dynamic happening there. And if they shift the demand for loanable funds to the right, which is a piece of indirect crowding out, that could lead to the same effect. We would have an increase in longer-term interest rates, and that of course would also shift the quantity of loanable funds in that market to the right. What about an increasing in savings? This is something that's happened recently as people became frightened over the financial crisis. The savings rate increased. That would lead to the supply of loanable funds shifting to the right, and that would cause the real interest rate to decrease and the quantity to increase. Just like you would shift any curves in either an individual market or aggregate demand and supply, the rules still apply. You ask yourself, what's happening? What event is taking place? Which curve would it affect? Shift that curve and then read your graph. And if you're being asked to draw that graph as an answer to a question, you need to include an arrow for each change that's taking place. If you stop and think about how that might look in the money market, something that may not have occurred to you is something that you want to see and you want to experience yourself by drawing it. Let's say that something happens in the money market, and that something is that the Fed decides to increase the supply of money. So of course, we're talking about this curve shifting to the right. And now we have S, M sub 2. That leads to a lower nominal interest rate, and it leads to Q sub 2. But whereas with so many other situations where you've had to graph, and I may have been difficult on you and I've said, please draw 3 arrows, draw 3 arrows. Because of the vertical nature of the supply of money in this market, there's only 2 arrows that need to be included. So it's just a small thing, but I wanted to make sure that you understood that. Those are the differences between the money market and the loanable funds market.